Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyers Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, good everyone. How you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Recording on a Tuesday morning, the day before or the day of the Reserve Bank meeting this afternoon. So I do not yet know how it will fall in terms of whether or not the Reserve Bank of Australia will put an official increase to the cash rate today. I don't know. But irrespective, and if you're connected in with the economy in some capacity, you'll know that we're moving into a different real estate cycle at the moment that we've been talking about it for 10 years, that there's a point in time when rates don't decrease, they start increasing. And I think a lot of the factors which are shaping Australia moving forward at the moment, you'll start seeing some rate rises in time, whether it's today or next month or in 3 months' time. We'll have to play that out. We'll wait and watch and see what happens this afternoon. We'll pick that up and give some sense to it all moving forward. But we are moving into that particular cycle. My time in real estate, well over a decade or so as a property investor and probably 15 years as a journalist, we're probably moving into one of the more interesting times. And I remember back to the start of the COVID pandemic and how real estate was a hot topic, being told by banks that we're going to see a 30+% decrease in property values. You're seeing the headlines right now as it plays out, particularly as we near the federal election coming up at the end of this month. So hold on. I hope you've got some thick skin as property investors over this period of time, because the media is going to beat this right up as we move up to the election, and then subsequent to that, what happens with our economy and rising rates and inflation, all that sort of stuff. I want to get some sense of that today, irrespective of whether or not rates go up today or into the immediate future. Joining me in the studio, I've got the crew, the guys back from OpenCorp, regular guests on the show, Matthew Lewison, who's CEO, and Michael Beresford, Director of Investment Service, to try and break this down and unpack it, not for today, but for the near to medium term future. What does it all mean? And guess what? You get to make a choice as a property investor whether or not you want to be a participant in this market or you want to sit on the sidelines. So you got to opt in or give up. Interest rates, missing the boat, and property timing. Should you be investing in this market? Yes or no? I don't know. It's a big question. I know I am, and I do like markets in flux. Matt, is this a good time to be investing in property?
I think absolutely. If you can overcome your fear, I mean, you're going to see people who have been investing in property for a long time are going to absolutely love this environment. It reminds me a couple other periods of time since I started investing in 98. The introduction of the GST in 2000 spooked a lot of people. There was talk about prices dropping. Obviously, there was a big run-up as a result of, I guess, that introduction of the GST, and I was fortunate to get into my second property just before it and got the benefit of some of that price growth. 04 through to 07, 08, and probably the 04, 05 period where we started moving into an interest rate tightening environment through that 3-4 year period, and there was higher inflation. I think it was the last time inflation was over 5%. And we saw initially a bit of a pullback in the market. People just kind of got a bit spooked and the sentiment shifted. But very quickly, the underlying fundamentals really started to sink home. And we saw rising rents, we saw rising prices because there was a bit more scarcity of stock. It was harder to bring it to market to offset that, I guess, to balance supply with demand. And as a result, prices went up for 3 or 4 years. And it wasn't until probably the latter part of that interest rate tightening cycle that prices started to come off in some capital cities, and it wasn't even all capital cities. And then I think history's kind of wiped that period out because the GFC came shortly afterwards, not because of Australia's housing market, but because of what was going on globally and in America. And so everyone focuses on that kind of 1 to 2 year period of the GFC, but the 3 to 4 years before that, very, very similar to what we're seeing right now across markets, with scarcity of labour, ability to deliver housing supply to meet the demand of the population, and it was a great period to own property. And as you know, I'm a bit of a history buff. The 80s with higher inflation ran from December 82 to December 89, with interest rates escalating every year. Prices went up in Melbourne and Sydney 150%. Rents went up 130%, and that, I mean, you can't overcome the economics of housing demand and I guess constraints on supply just by putting interest rates up, which I'm sure we'll get into later. All the other things that are going to, I guess, play off as a result of perhaps higher prices and higher interest rates. But I said, if you've been in the market, you've probably seen it before, and if you haven't been in the market as long as we have, well, there's definitely history there and data that kind of gives a good indication of what might come out. What about you, Michael? What's your view?
Yeah, I think you've summarised it really well, Matt. The way I talk to our clients and my team talk to clients about it is interest rates don't go up in isolation of a whole range of other things. You know, the property market and the economy is a whole range of complex variables that are shifting. You know, personally, I have a saying, I like it when interest rates go down because your property portfolio is more effective from a cash flow perspective. But I love it when interest rates go up because all of the things that are happening as a result of requiring interest rates to go up, like job creation, like wage growth, like tight labour markets and shrinking unemployment rates, rents going up and prices going up. As an investor, that's exactly what we're after. I think it's a little bit different this time around in that it's been 10 years plus since we've seen an interest rate rise. People kind of forget what happens, but as Matt said, once we kind of adjust to that and we realise that the government has a need to generate revenue, there's going to be a commitment to overseas migration. A lot of the growth that we've seen in markets in the last 18 months or so has been driven by net interstate migration, along with affordability, obviously. There's not one size fits all as far as Australia's property market's concerned. There are different markets within markets, and each capital city market or regional market is different again. So I'm sure we'll unpack all of those fundamentals and the differences between them as we go today.
Yeah, it's a complicated environment. You got a lot of people now commenting on this, and some people are rightfully commenting it, and then you've got sort of more armchair commenters who are just jumping in here trying to give some sense to it all. My view and my sort of guidance to all property investors is just be pretty considered where you're getting your information over this coming period of time. There's going to be a lot of bias in what you read, and there's going to be the doomsday merchants, and I've already seen it. Matt, you've probably seen it as well, Michael, of this is the bubble we told you was going to come, and now it's about to burst, and you've already seen those headlines. You're going to get some other more hawkish commentators talking about the benefits of property, irrespective of the market cycle. Now, let's just be frank with it all. This is a normal market cycle. Property goes up, property goes down. Interest rates go up, interest rates go down. And there's a lot of reasons for it, and it's all interconnected and complicated. It just feels as though, Matt, this time around, that the complexity needs to be sort of manifest by a whole bunch of other environmental or situational factors. One will be the sort of COVID hangover, what it all means, and some of the supply chains constraints around it. We've got a war in Europe, which seems to be exacerbating. So it just seems to be these layers of compounding. This particular moment in time, to me, is what makes it so uniquely interesting as an observer, but also a participant in property. But, the 2021 price growth was extreme, and everyone's sort of spoken about it. And again, you go and look to the commentators on this. One day they're telling you that the bubble's bursting because it's 30% down, and then it's going to be the boom times ahead, right? So we've gone through a pretty interesting time. Some people were just saying, hey, it was just catch up because of the APRA intervention a number of years earlier. But is investing actually viable in this market? No doubt your answer is going to be yes. So how do you go about playing the right hand at the right time?
It's a great question, and it's a really complex. It's a tough one to answer. Interest rates, and I mean, all those complex things that are interplaying. I think it's easy. It's all getting pushed into one bucket, right, in the media, and it's all comparing the election and the war, COVID, and the lockdowns in China. And I think what we need to be really careful of is not to get caught up in all of those things, and we try to bring it back a little bit closer to home and say, well, what is happening right in Australia right now? As I said, the key things in Australia, there's scarce labour. There's scarce labour because we've had our borders closed for quite a while, and we've got a lot of activity. There's been a lot of investment in infrastructure. I mean, investment is great, right? When the government's investing in infrastructure, it's putting money into the economy, it's creating jobs. So that's a win. Now, borders are also starting to open or have recently reopened. We're seeing an influx of students coming in from overseas, and obviously starting to fill some properties that were vacant in Sydney and Melbourne around the CBDs, and some of the student accommodation starting to get fuller. But we're also starting to see more skilled migrants starting to come back into the country. And unfortunately, our population data is about 6 months behind. So we're always looking in the rearview mirror. We don't yet see post 1st of January, and I think it was at February when those borders really started to open up more widely. But absolutely, we're seeing more people. There would be more people coming into the country, and that's going to mean there's going to be more workers to do some of those jobs. It's going to take some pressure off those labour markets and supply markets within Australia. It's just there's a lag between the data and the reality, and I guess those things taking place. But again, if I think through what's the domino effect of this, well, more people coming into the country, well, that's more people, let's use the term bums on seats, in rental accommodation initially. So again, there's going to be more tenants in an already tight rental market. That's going to put more upwards pressure on rents. So home ownership, particularly for investors, is about the cost of holding a property. So if interest rates go up, but your rents go up at an equal or faster pace, it's actually becoming more affordable for you to hold property. I guess what we do see in these market cycles is the first casualties are the owner-occupiers. The first home buyers are the first ones out because it does become tighter for them. However, there is a lag before they start to pile back in, and they pile back in because their rents are going up at a rate that they're no longer comfortable with. Hobart was a great example of this over the last 4 years. They've had a huge uplift, and there's two different types of markets we've talked about before, a push market and a pull market. Pull is when the price is at the top, when the executives are getting big bonuses and there's just a lot of confidence in the economy, and people start paying top dollar for properties, Bosman, Toorak, Bondi, and it drags the price up, and it makes all of the suburbs around them seem more attractive on price basis by comparison. So then it drags them up, and obviously that has a flow-on effect. A push market is very different because a push market comes from the bottom because there's a scarcity of housing, there's an affordability issue, and people can't just afford to keep going for the most expensive properties. So they actually push into the markets, and the suburbs are the most affordable, pushes up the prices. And because it pushes up the prices at the bottom, the suburbs near them that are a little bit more expensive no longer look as, I guess, they start to look more attractive again. So people start to push into those, and actually pushes the suburbs up. But what we find in the push market is that the difference between the top price and the bottom price starts to squish, so that it compresses, and you see a lot more sales in the bottom half. This is, again, something that we need to be really clear on when we're reading media reports or forecasts about a change in the median house price and a potential reduction in the median house price, because the maths is that the median is the middle price. If you sell, obviously, 10,000 properties, it's the 5,000th sale that becomes a median. So if you sell 10,000 or 7,000 more affordable properties in a given period, the median might drop, even though the suburb medians in those areas are actually going up because of the extra demand there. And it's not what the media reports, and it's also not what the bank talks about. The banks talk about the median house price. And absolutely, we're going to see a compression. The difference between the top and the bottom price is going to get smaller. And again, to use Hobart, it has the smallest difference between a house price, the median house price, and the median unit price. it's about 30% premium, whereas in Brisbane, there's an 80% premium for a house over a unit. And the reason that Hobart's is so compressed is that they had this rental affordability crisis for the last 4 or 5 years, pushed a lot more people into affordable properties, which pushed up the floor of prices in Hobart. And obviously it wasn't pushing up the top prices, but it was compressing the gap. So, very critical to understand the maths and I guess.
And Matt, that's really well explained, mate. And it's probably one of the best explanations of that push-pull market I've heard. And there's going to be people who will not fare too well over this coming period of time. But, again, you've got to be careful of the numbers. And Michael, I know this is your beat, right? Got to be careful of the numbers. If you're looking at the aggregated median of the Sydney property prices, considering what Matt's just spelled out, you can see the reason why prices might start to drop at a median level, because you've got more activity at that end of the market. And that's just supply and demand. It's difficult because we've come off this big boom, and I want to get into it. We've just got a quick break. Stay with us, everyone. Back in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with Matt Lewison and Michael Beresford over at the team at OpenCorp. And touched on numbers before we went to the break, Michael. There's going to be some casualties as we move to this market. I was reading in a paper today. I think it was a story of and let's remember, this is a podcast for property investors. This is not a podcast for owner occupiers, but it was a story of a single mother with 4 kids who now needs to go get another job because she's bought a property at a period of time when she may have overpaid for it. Now interest rates are going to start creeping up and she can't afford it. You put that into some sense. We'll get into affordability in a moment as we near this election. Of housing affordability is a key policy point for both parties. And we're seeing that the Australian government is willing to start investing in Australian property through supplementing and complementing owner occupiers to get in there. Now, that's a good thing and a bad thing. The fact that the Australian government's got skin in the game, they're going to probably want to keep prices up where they are, which is good news for investors. But philosophically, people are going to be sitting there, and we touched on it briefly. I want to get into it, that we've been through this boom. So therefore, I'm just going to hold off because it's inevitable that there will be a downturn. Now, you look at that push-pull thing that Matt just spoke about. You're probably going to get a downturn in parts of that market, but I think at the affordability side of the equation, you're probably going to get a surge in property moving forward. What's your take of it all? Can you give me some sense to it? Because it's bloody complicated.
You've given me a lot of stuff to talk about there, Phil. So yeah. I'll try to keep it in a logical format. But the very clear message for investors is I don't know anyone that makes money by not being in the market. And, if I was to ask you, with the benefit of hindsight, would you have bought a property 20 years ago or 30 years ago? I'm yet to meet someone that says no. But if I was to tell you back then that a whole range of things were going to happen, like a GFC, like COVID, like the recession that we had to have, negative gearing taken away and brought back in, September 11, et cetera, then the number of people that would have been willing to buy back then, shrinks dramatically. So to Matt's point, there's a lot of stuff going on, but having done this for a long time, I find that the most successful investors out there are the ones that can block out what we call the white noise and focus on the fundamentals. And the fundamentals are that as a property investor, we only want our investments to do 2 things for us. Number 1 is to bring in cash flow, and number 2 is to grow in value. So if we isolate those 2 things and we say, well, what determines the cash flow that we bring in? Well, let's look where there's solid rental yields, and let's look at the segment of the market where there's going to continue to be upwards pressure on rents. And that's a very different equation at the affordable end of the market compared to at the top end of the market where yields are very poor. The second part we can look at are the tax benefits that come in. So what are the kinds of properties that can maximize the tax benefits? Because if the interest rates go up, but as Matt says, the cash flow that comes in compensates or more than compensates for the increase in cost, that's an effective investment. There's still no impact to us from a bottom line point of view in terms of money out of our pocket. If we look at the growth side of things, again, let's have a look at where the demand is going to be. And if you're one of these overseas workers that's going to be coming back into Australia or already come back into Australia, and you can be moving into, an expensive market where the median might be 1.5 million, or a more affordable market where the median's 650 to 800, for example, then there are going to be different levels of demand at those different price points. So the message that I'd give the investors is really try to keep things simple and focus on the fundamentals. Just a couple of examples that are clear from history for me. We might remember it wasn't that long ago, but at the start of COVID, there were the headlines around prices to drop by 32%. Now, as we've just talked about, that's the median because that's the price that's measured. It doesn't mean that every house would lose 30% of its value. But if that spooked you, and 2 years ago, you sat out of the market because you were thinking there was going to be a drop of 30%. And remember, this was the bank saying this. They said that the drop would be 3% to 32%. So I read that and I said, well, I don't think the banks actually know exactly what's going to happen because that's a pretty big range. Okay. But if you'd read that and held off and thought, okay, well, worst case is 30%, but in reality, we've seen 30% up. Well, there's a 60% difference there in only 2 years. So the impacts of being out of the market can be dramatic from a wealth creation perspective. Obviously comes with a caveat: protect your cash flow and make sure that you're investing in properties that aren't expensive to hold and draining money out of your pocket on a week-to-week basis. The thing that I really liked that you said earlier was be very particular around where you get your information in times like this. An American commentator that's constantly talked about how the Australian property market is different to America's property market. Harry Dent, he always seems to get some airtime when he's got a new book to release. He said back in 2012 that the market was going to crash by 60% in Sydney. It was overpriced. In the 5 years after that, it went up over 75%. So I would have loved the opportunity to ask Harry what he would say to all those people when he was 135% wrong. Haven't had that opportunity yet, but the point is, right, to be focusing on the fundamentals. That's what we're trying to share with investors in this session on this topic today. There might be some short-term movements, but pretty quickly the fundamentals balance out, and we still see it as a market full of opportunity, definitely that affordable price point level.
And your sort of take of that, Matt?
I think so. As like a personal example, I guess, from years ago, I've got a cousin who obviously following properties in our family, had been following myself, my brother, my dad, and our investments, and he came into some money, and he was talking to my dad about whether he should invest, and he held off for a few years, and then the market boomed in that period, and I know his sister was really keen to invest, and he said to her, well, look, the market's boomed now. Maybe we should wait until it crashes so that we can get into the market cheaper. Fortunately, she kind of said, well, I want to move into this house, so let's put our money together and we'll buy it to help him get off the fence, because he probably would have continued to procrastinate for years. Fortunately, they did, because the crash didn't come, and they made a considerable profit and ended up being able to buy another property. I think it was within 18 to 24 months. So that mentality of waiting until prices correct in the hope that you can get into the market cheaper. I mean, I'm not a gambler, and I'm not suggesting that the property market is gambling in any way. But if you went to a casino and they said, hey, I can place a bet for you, you've got a 90% chance of winning every hand and a 10% chance of losing. And if you win, you make 100%. If you lose 10%. Does that seem like a good odds to you? I would have thought so. And the market generally, 9 out of every 10 years for the last 50, 60 years has gone up. You don't know when it's going to correct, and obviously there's a bit of a misnomer about what a correction actually means. But more often than not, the market is likely to continue going up, and it's in everyone's interest, including the governments and the banks, that prices remain stable and that they increase steadily.
So I'd probably wrap all that up with a nice headline as a journalist, as in you snooze, you lose. And it's as simple as that. You get to make a choice whether or not you're in the market or out of the market. That said, there's got to be a lot of losers in this market who are investing in property. It comes back to asset selection. And we've spoken about that at length, in particular with the OpenCorp guys over many podcasts. Go and tune into that. So just don't think, hey, I'll get in property irrespective because you've got to make money, right? Well, yeah, let's be fair. Over the last year or so, you could have bought anything in Australia. It probably went up in value, but that's probably the stuff that will come off moving forward. So you've got to be really smart with what you buy, but you've got to embrace the psychology around if you are able to invest in property, you've got everything sorted out. If you're financially secure, you've got all those things that we speak about on smartpropertyinvestment.com.au at length about all the time. Start looking and sort of this point around mindset around it, Matt. And this is there's lots of famous quotes around it, like, Warren Buffett about, this whole counter-cyclical investing. You should be investing when others aren't, and all this sort of stuff, right? Like, interest rates are going up. And you're investing in an expensive market when rates are hiking. So everyone's going to go, is this actually a good idea? What do you say to break down that mental roadblock to say, well, yes, it still is a good idea, but you need to ... What's the ...
Look, I think, you've already covered it just a few moments ago about investing wisely, not just throwing your money out at anything, because when there is a saying, all ships float in a rising tide. So when you're in a bull market and everything's kind of going up, it's easy to get complacent. In a market like we're moving into, particularly knowing that the metrics are going to shift. There's going to be more investors that will be active in the market for the next year, I'd imagine, than first home buyers. But there's really, it's not rocket science picking suburbs that are affordable, where there's a good rental yield. Everywhere's still got tight vacancy rates just about in the country, particularly around capital cities. So making sure that you're putting your money that you're investing in a safe and secure place. Now, generally, this is my psychology when I was in my early 20s starting as an investor. The only thing I worried about was whether I'd be able to afford to hold on to the property if I lost my job. And this is kind of something that I've always found in property. People feel safe and secure in their jobs, they'll invest. They'll put their money towards, I guess, their future. And it's only if they don't feel safe and secure that's when they really sit out. So right now, every single human being in Australia should be pretty confident about their prospects of earning an income for the next few years. I've got a 9-year-old son who's seen all the signs in the shop windows asking for staff, and he's asking me every time we walk past if he's old enough to start working yet. And I'm sure he'd clean up if he was prepared to go and wash some dishes at a cafe or something. But everywhere is almost every business in the country is looking for people to hire. That's going to build a lot of confidence. And as we've talked about, it's a heap of noise. There's an election that always makes it even worse, right? So we'll get through that election. I can't predict what's going to happen in Ukraine, but we're seeing less and less about that war already. So I think maybe everyone's just tired of hearing about it, and the focus is shifting to other things. And no doubt, once we get through this first interest rate hike or the first couple, the noise around that will start to diminish as well, and we'll move back into normal. And as you said, the start cycles go up, interest rates go up and down. We go through different media cycles. There's always stuff going on. It's always a reason to sit on the fence. And as Michael said, and I think it's I can't remember who it was. Was it Wayne Gretzky? You miss every shot that you don't take. And it's the same in property. If you don't invest, you're guaranteed to lose. So if you're confident about your job, you're investing somewhere where you're going to have a tenant who's paying rent, and you're confident in your ability to service that loan, well, there's not really, I guess, much to have concern about. Michael?
Yeah, really well said, Matt. The only thing I'd add to that is, Phil, is keep some perspective. So smart investment, as you say, is around not overextending yourself, having buffers, and to Matt's point around, protecting your cash flow in the worst case scenario that you lost your job, then those things should already be in place as well. So as that adjustment happens in the market and people kind of, remember that we're not going from 9% interest rates to 12% interest rates, we're going from 0.1 up a little bit, keep some perspective on that. But at the same time, buffers built in to cover these differences. With rental growth, you probably won't have, or shouldn't have, if you're buying the right kind of assets, any major impact to cash flow. But if those buffers are there, have a buffer that gives you a comfort level for years to come. So, what if you couldn't contribute the holding cost of, say, $50 a week for a property for 5 years? Highly unlikely in a tight labour market, but let's use that as the example. That nets out at about $10,000 that a buffer of that size could hold that property for you without you contributing anything. And if we look at the fundamentals of the market today, and using Matt's data before of 9 out of 10 years the prices go up, say, well, do we think the prices are going to be higher in 5 years than what they are today? Then that buffer is really money very well spent in the worst case scenarios. So I try to keep perspective. I try to always look at what is the worst case scenario, protect against that. And remember that we're not, or we shouldn't be investing to try and make money in property by August. We're taking a long-term view, and property stood the test of time over the long term for sure. So hence why we encourage investors to focus on the right information and be diligent with their financial buffers and so forth. But you got to be in it to win it, as we say.
Yeah, and look, all really well observed. And what I would add to it, and I'll just summarize all that, is that everyone's sort of hyper focused on this right now because of these things that happen in federal election, affordability discussions, hiking inflation, and the potential for interest rate rises, official cash rate, and the interrelation with that with the banks. Look, the banks are going to probably come out of the blocks pretty quickly and up mortgage rates. So everyone's really focused on it right now. But you only got to think back to March of 2020 when COVID first hit us, and the narratives then largely by the middle of the year, if you're not in Victoria, it was largely normalised, and now there's just this acceptance of how it works. The same with everything else. So hyper focus for the moment. It will be normalised over time. So don't make your decisions based on what the 3 months ahead looks like. Make those decisions based on some of the stats that the guys here have used today. But affordability is key. I want to just jump into that quickly, gents. We'll just go to another break. Back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Good day, everyone. Welcome back to Smart Property Investment Show with Michael Beresford and Matt Lewison. Phil Tarrant hosts a bit of an economics lesson. I don't know which one of you guys is probably best, maybe you, Michael, to handle this. Affordability. There's a lot of things which are counter-cyclical. So people go, oh, hang on a second, you're trying, cost of living is going up and it's more expensive to buy stuff. So you're going to put interest rates up, which even makes it more expensive for your mortgage. Isn't that sort of the opposite of what you really want to be achieving as a reserve bank? So this is a whole bunch of stuff which doesn't make sense for a whole bunch of people right now. And affordability in terms of interest rates are good for investors because rents are rising in those right markets. But is an interest rate rise going to exacerbate this whole sort of ecosystem? Can you give me some sense of how it all sort of works through the lens of a property investor? Not someone who's buying their groceries every Friday down at Aldi.
Yeah, look, Matt will have a great explanation for this, I'm sure. But the perspective that I bring to it, Phil, is As you say, think of it like a property investor. So the reason why there's so much alarm at the thought of interest rates going up is, A, we've seen prices grow. The majority of those properties that have been bought are by owner-occupiers, and the only source of money that they've got to be able to cover the mortgage repayments is their post-tax income. So, yeah, absolutely, there's some increasing contribution required and maybe some pain out of pocket for people that have overextended in that area. But as an investor, if we think about all the related forces, the cost out of our pockets, even if the interest rates jump 1%, right, most properties are going to be still cash flow neutral. They might not be super cash flow positive. They might come back to cash flow neutral, maybe cost you a little bit out of pocket. But again, if the cash flow impact's not significant, the benefits of why interest rates go up, inflation on prices, income growth, etc. People have got more to spend. Then we can benefit from those as investors, because the vast majority of the holding costs, if not all, are actually paid for by other people. We're not covering 100% of that cost increase ourselves. So that's how I see it as a property investor, is kind of keeping some perspective on that, and making sure that, like I said before, prudent budgeting means that you can cover slightly higher costs. A rising and inflationary environment, rising interest rate environment corresponds to price growth. And what we have seen in other cycles, it can be a little bit counterintuitive, but as interest rates start to go up, we do sometimes see an influx of buyers into the market because they want to come in thinking they can fix an interest rate before it goes up further, not necessarily realizing that the banks are always one step ahead, and the fixed rates have gone up in maybe 6 months ago or whatever it might be. So I'm sure Matt's got some things he can add to that.
Again, interest rates tend to go up to offset inflation, and inflation by definition is the increase in this consumer price index, at least in terms of how they refer to it in Australia when they're talking about inflation and giving it an inflation rate. The consumer price index includes a basket of goods, which covers things from housing to food to recreation, transport, furnishings, health, education, clothing, and communication. It's a whole range of different things that are kind of like staples for Australian households. But the biggest item is housing. And this is the really interesting thing, because the housing cost that's included in the consumer price index calculation, there's a portion of it related to obviously the cost of buying a house, but there's also a component of it that's related to rents. Now, let's just speculate for a moment. If costs are going up, costs to produce a new house are going up, and interest rates are going up, maybe less new houses will get built in the next 12 to 24 months. If less new houses get built in the next 12 to 24 months and our population is growing, well, our vacancy rate is going to be going down. And when our vacancy rate's going down, rents are likely to be going up. So it's a really, I guess, interesting interplay, because as interest rates go up, we've all heard people say when interest rates go up, rents go up. And it's not the interest rates that push the rents up. The rents go up because fewer new houses get built for a period of time. And obviously it increases the scarcity of rental accommodation and keeps more people in the rental market, which pushes the rents up. And again, it makes it really challenging for the RBA, because right now they'd be looking at the CPI and saying, well, how much of this can we genuinely influence? If we put interest rates up, people will contribute more money to their mortgages, which means that they're going to have less money to spend on shoes, on food, on insurance, on travel costs. And so they're obviously trying to influence a whole heap of things, 80% that isn't housing. And some of that 80% they're going to have absolutely no influence over, because it's driven by forces well outside of Australians' hands. So again, it's something that the media really plays up, that, hey, there's high inflation, so the interest rates have got to go up a lot. But it's actually counterintuitive, because the more that the RBA puts interest rates up, the more stress they're going to put on renters, and it's going to make it harder for them. The people who, in theory, they're trying to protect by obviously putting interest rates up and taking some heat out of a housing market. So it's very, very complex. It makes it very hard to predict. And if, as Michael said, every forecast that a bank issues about the housing market tends to be wrong, and they tend to be a lot more conservative than reality. We also look at the ASX 30-day interbank cash rate. We look at it monthly. And 6 months ago, they were forecasting no rate rise for a year and a half. Now they're forecasting 5 of them in the next 3 months. And they're going to be wrong. They've been wrong every single time that I look at it, other than normally for the next 1 to 2 months. And they're wrong because there's just so much complexity. But I always come back to, it's in the bank's interest to make sure that prices don't go down. It's in the government's interest to make sure that prices don't go down. And the government actually and the RBA wants inflation, because when the prices of things are going up steadily, people are more likely to buy. And they want people to buy because it creates jobs. And I'm not saying they want them to buy houses. They want them to buy everything. They just don't want them to all buy it at exactly the same day, because that's when the cost of living goes up. So it's heavily weighted in favour of price increases.
Yeah, and this goes back to this specific environment, which is a little bit more complicated than probably past markets. And you spoke to it, Matt, and the whole supply side issue with the building industry right now is going to, the ramifications of that probably won't be felt for a couple of years' time. If we're not building places, that's the cycle you spoke about, things going up. But these sort of economic boffins sitting around board tables at the Reserve Bank of Australia, they'd be having some pretty interesting chats right now. And I don't know, you've probably seen the same pictures that I've seen, like literally thousands, if not tens of thousands of massive container ships sitting off the coast of China, waiting to put themselves at port to pick up stuff to take around the world. It's a big and it's a significant issue, and that's something that's completely out of the hands of any decision maker inside of Australia. We just got to work out how we react to it. So, I think and I believe you'll see tempered growth in interest rates moving forward, because we cannot make any firm decisions as a nation and as the RBA until we see a more normalised environment for the supply of goods and normalised trade, unrestricted because of the COVID-19 pandemic. And that's still some way away, would be my view. If I was going to be called out whether or not there'll be a rate rise today, we don't know. But a lot of those question marks, I think, are definitely there right now, and that may keep the Reserve Bank of Australia considered, and maybe wouldn't be putting rates up today. But who knows what's going on? I think Matt and Michael, you've explained pretty well a lot of those the economic realities of this environment. But the message I take clearly from both of you is, property largely is a sensible play for wealth creation in Australia. So don't be too absorbed in and the immediacy of the noise and the white noise in the market right now. If you're ready to go would be my summary. Do you guys concur?
100%.
Absolutely.
All right. Well, some predictions then, Matt. I'll round out with this question. Let's fast forward 6 months, mate. What are we going to be chatting about, do you think?
I reckon we're going to be chatting about how quickly Melbourne's turned the corner. Melbourne was the market, probably had the least favourable fundamentals following their long lockdowns. And I think parts of that market are going to really surprise people. Okay. And I reckon also Perth's finally starting to see it's getting its day in the sun after 8 years of being down in the doldrums. And we're starting to see that really starting to come to the fore now. And again, it's the most affordable city in the country. I can't imagine it'll stay that way for long.
Fair enough. And if people want to reach out to you guys, Michael, what's the best way?
So you can jump on our website, www.opencorp.com.au. If you're interested to look at your individual situation and see how we can possibly point you in the right direction, there's an option to just click on a strategy session request, and one of the team will be in touch.
All right. Sounds pretty good. To go check them out, opencorp.com.au. Hope you enjoyed that, everyone. Quick favour for me, please. I get the good job here. I get to chat to people, but there's a big team here that make me sound good and produce this podcast. They get a real kick out of those reviews. So please keep them coming. Remember, smartpropertyinvestment.com.au, social media. That's how you like to get your info. Smart Property HQ. Across all the platforms, you can find us there. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.